All right, traders, what's going on, guys? Cleveland here with Top Traders. Wanted to talk to you guys today about something really interesting. Something that still happens, even though there's a ridiculous amount of information on how to avoid, capitulation, avoid blowing your portfolio. There are still thousands of traders every day, every single day, okay, that are blowing their accounts, right? I mean, I have a lot of connections with different brokers, and I get so much data back. Or I'll just monitor a trader, right? Just monitor a trader, or they'll even monitor a trader. They'll see somebody throw in $10,000, $15,000, and the money's gone within 30 days. I mean, I've literally seen this before my very eyes. And there are so many reasons why this is the case, but I wrote down a few that have just really stuck with me throughout my entire trading journey. And I think it could really help you guys if this is something that either you want to avoid, okay, which is good. All right, take the vitamin. But some of you guys might also need the painkiller because some of you guys may have also experienced this at one point, right? I've blown one portfolio in my entire life. This was all the way back in 2011. I was trading with my best friend, Ryan Mitchell, to this day, my best friend, Ryan Mitchell. We were trading back in E-Trade, all right? We opened up an E-Trade portfolio and we were trading the stock nanotechnology, all right? We didn't have any experience, freshman in college. I was a finance major, but I was just getting my feet really in the business. And so obviously we started to talk a little bit more about markets. We were really talking more or less about cash flow operations. You don't talk really about the capital markets until like your junior year or senior year in college. But it was there, right? And so we immediately started to look into penny stocks because obviously that's where you get rich, is you get rich in penny stocks. Before all this Forex buzz, everyone was trading stocks, okay? And guys, this is gonna sound hard to believe, but the first stock I ever traded in my entire life by myself, I had a custodial account with my dad. My dad was a trader. He was in the trading business. He also was a finance major as well. But before him, okay, I never simply threw something out there in the market. Well, with my friend Ryan, I threw something out there in the market, and it was a stock called Nanotechnology. Right now it's called Intek, N-T-E-K, okay? They sell arcade games, okay? Right now the stock is non-existent really. Its volume on any given day is probably less than 10,000. I can look, but it's not existent as well. All right, but back then the stock was trading at 0.00 maybe 3 or something like that, maybe 0.005 on the high end. We bought that stock. I bought 80,000 shares of it, okay? And long story short, my 80 or 90 bucks that I put into the stock ballooned into like $5,000, okay? In the span of just maybe about 2 months, all right? And so boom, we withdrew some profits. Ryan got out a little bit earlier. He got out maybe out the $3,000 range. But at the end of the day, of course we thought we were geniuses. Okay, but after that, after you give a 19-year-old kid, $4,000, $5,000 by just throwing some random money into some stupid ass little stock, what does that guy go do? He goes and doubles down. And so at one point, this portfolio grew to 12 grand, and just like that, it wasn't even, what was it? 2013 came around. I don't know if you guys remember this in any capacity, but this was also around the time that marijuana stocks got popular. Colorado legalized. My whole thing wiped out, okay? We threw in all the money into CBIS, MJNA, these are all different marijuana stocks. They ballooned, and then eventually they all went to basically zero, and we lost all the cash. All right, so after that, all right, that's when I realized, okay, maybe this game isn't really for me. I've really just stepped back for quite a while. Okay, but then eventually I got further in my education and started to go through a couple of different things that really helped me rationalize how to manage a portfolio. And that's the first thing that I want to talk to you guys about, okay? I know you guys consider yourselves Forex traders, but I don't want you to consider yourself a Forex trader. I want you to consider yourself a money manager that trades Forex. Because what that's going to do is that's going to prioritize your mindset to immediately thinking first about the preservation of capital. And then you're going to start talking about maybe what trading opportunities are out there, right? But one of the biggest problems as to why traders can't do that is because they're undercapitalized. And I'm hitting off on a lot of different things here. So one, make sure you guys prioritize money management first by saying you're a money manager that trades Forex. And then secondly, if you're undercapitalized in the business, and you're trying to rambunctiously just trade up your few $100 to tens of thousands of dollars, I've been in that game. It's less than a 97% portfolio to a deep 4-figure and definitely probably not a 5-figure portfolio. The problem that you're having with doing that is because it's very unlikely to happen. Okay, and so again, this is why traders blow their portfolio so much. They are risking so much percentage of their capital. They're not risking a lot of money. Usually they're just getting into markets with, again, a few $100, maybe a few grand, but they're risking so much percentage of that money that of course it's going to eventually blow up because you're just trying a little bit, maybe too hard to get some type of return. You have no edge, you have no strategy, you've never managed money in your entire life. You've never had an investment portfolio. You've never been formally trained, right? I mean, these are some of the reasons why I think it's going to be extremely hard for anybody that has never been exposed to any type of corporate portfolio management theory, any type of corporate setting where you're trying to analyze risk like some type of actuary. If you've never been in these environments of managing risk and understanding how to take on risk and understanding all the variables behind capital flow, then how could you ever just randomly just open up an account? Yes, the charts are moving all over the place. That's irrelevant to the money management side. It really is. You apply risk to instances where you hope that you have an edge. That is the name of the game. Applying risk where you hope you have an edge, but it's the applying risk part first, okay? Where you hope you have an edge. And again, that's hope. All right, edges, they come and go. Opportunities come and go, right? So guys, I just want you to be very careful in that capacity as well, all right? Not being so undercapitalized. Forex is not the game to try to flip your account as much as the entire internet is going to try to sell you on that idea. Another case that I can make to you guys to maybe help you rationalize how crazy it is that portfolios, they should never be blown. Okay, when you look in the hedge fund industry, all right, which you should do your research and get into the idea of looking into how other big money managers are managing capital. When you look into when you look into a hedge fund that blew up, do you guys know that they consider blown up by usually 50% drawdowns? If a hedge fund loses half of its money, the hedge fund usually that's it, blown up. That's when everyone's liquidating all their capital, right? Because hedge funds are these private entities where these, seemingly fairly successful investment managers say, hey, we can manage your money. You have to be an accredited investor, usually, most of the time. And you're putting that capital, you're hoping, you trust in this individual to trade your money. If you see your capital decline by 50%, especially in a short amount of time, okay, and what do you consider a short amount of time in a hedge fund world? It could be 2 years of 50% loss is enormous, let alone 6 months, let alone some of the cash, just let alone some of the portfolios I've seen where I've seen guys blow 90% of their money in 30 days. Okay, so again, the way they do it on the institutional side, I think you should adopt. I think the retail guy should get deeper and deeper into the game of understanding how professionals are managing the money and just adopt those same strategies. They've been doing it for years. This market is for them. Okay, now can retail traders have larger returns than the institutional guys? I think so. I definitely think so because there's less safeguards. You have full autonomy to do whatever you want here, okay? But usually when you're at a firm, you have to talk to the trader, then you have to talk to the risk analyst, and then you have to talk to the portfolio manager, and then you just got to talk to probably the guy who runs the damn thing, usually the portfolio manager. But at the big firms, not so. All right, you might have to talk to the guy who's actually doing the securing of clients. Sometimes he might be in the protocol of making investment decisions. Who knows? Okay, but at the end of the day, there's a lot of steps. When you're managing your retail trading portfolio, it's just you and your computer. You can do whatever you want. So that also means you can take opportunities as they come quicker. And that also means you can liquidate losses on the idea that maybe that trade isn't going to work out. So I think that the retail trader has many advantages that maybe the institutional guy doesn't have. But the one of many advantages that the institutional guys have is the structure, okay? They have the structure. They're usually coming in as some type of entry-level guy with a massive amount of guidelines, a massive amount of risk protocols, and a lot of history, obviously, right? If it's an older firm, a lot of history of, hey, this is how you do it, all right? This is what you need to do in regards to getting this portfolio to a higher equity value than it is right now, all right? And so the last thing I want to touch on, guys, is big risk and big return. And I know we kind of touched on it a little bit earlier in regards to flipping the portfolio, but I just want to hammer out on that. Big risk does not equal big return, right? That isn't true. That isn't like some type of thing founded in portfolio theory or some type of thing founded in just how markets work. The more money I risk, the more money I'm going to make. No. The more money you risk, the more money you're going to lose. I mean, the more likely it is you're going to lose a lot of money. Okay, why is this the case? Because it's just been proven based off of a trader's psychology. Usually the size of the risk never equates back over to a substantial gain. It usually does equate back over to a substantial loss. Okay, and this is mainly because the idea that traders, they hope for a loss, and they're nervous and they're very quick to take profit on their winners. Okay, so you will usually tolerate a larger drawdown than you will like to see a huge running profit and just sit back and say, hey, let the thing go, dude, we're good. It's gonna keep going. We got about another 1,000 pips to go. Very rarely is that the case. Usually you're freaking out and you're cutting profits way sooner than you're cutting losses. If that wasn't the case, then the 97% failure rate in the business wouldn't exist, okay? That is probably the main reason why. The hope that your losses are gonna come back and the fear that you're not going to be able to pull that profit. You gotta take that over, you gotta reverse it, okay? Ways you can reverse that, of course, is by not having such large positions at first. What you can do is simply just have a nice manageable size position, okay? And then this way, you can be a little bit more logical in your approach. You have less emotion, and this is gonna allow that trade to actually run to its full profit potential at some point. And then also something that we don't talk about a lot on the channel, okay? And this is usually because a lot of the guys that we're talking with, they don't have a substantial amount of capital to trade with. But for my guys who do, which there are a lot of you guys who do, Forex options are definitely a thing, okay? So you can't trade Forex options in the capacity that maybe some of you guys are thinking with binary options. I mean the actual vanilla Forex options, one that you can get to, you have access to in Thinkorswim, you have access to them in maybe Interactive Brokers, E-Trade, so on and so forth. These are ways that maybe you can start to mitigate losses or hedge positions entirely. The only issue there is that the usual leverage that you're managing capital with in the actual spot market doesn't correlate back over to the leverage amount that you have with the Forex option. Forex options, your leverage amount is maybe 1-to-6 leverage. So to actually have a true correlation in regards to the actual capital running, you will need to have a leverage amount in your Forex broker no more than 1-to-6 leverage, maybe 1-to-10 leverage max, because your Forex option is usually not going to be as highly leveraged. But what that's going to allow you to do, guys, is let's say you have some type of idea where you want to buy the Euro USD. You can immediately say to yourself, okay, well, in the case that this Euro USD buy doesn't work out, I can buy some puts, okay, on the Euro, and I can also buy some puts on the dollar futures, and this is going to hedge you entirely. And so this way you pay the premium for the puts, okay, and boom, that's done. Your loss is capped. But then this also gives you tremendous amounts of upside in the spot trade, all right? So this is the way the bigger institutions are actually executing in markets. It's a way that you can almost, again, mitigate risk entirely, but it's not until you have around a $15,000 or $20,000 portfolio that you're able to access those type of opportunities. Understand, the smaller you are in this game, the harder it is. Okay, why do that to yourself? All right, when you can kind of wait it out, learn as much about the industry as you can, come in a way that is going to actually allow you to trade and actually allow you to be more, I guess, adept to managing money profitably. And then that way you can actually truly start to grow your portfolios. All right, so guys, let me know what you guys think. You never have to blow your account ever again. Okay, manage your drawdowns. Monitor drawdowns more than you monitor your profits, and then your whole business model is going to change. And the relentless blowing up of accounts, 4, 5, 6. I've heard guys who've blown up 15 trading accounts and they're still like, it's going to happen one day. I'm going to become successful. You're a lunatic, all right? If you're not going to trade it the right way, and if you're not going to do something a little different, then it's never going to change for you, all right? So guys, let me know what you guys think. If you're blowing portfolios, definitely take notes here, and it's going to be very, very helpful. Look a little bit deeper into what's happening on the institutional side. That's what we teach in our Top Trader Academy. It helps a lot of our guys really start to understand how to grow money while taking on these risks in markets. If you want to take a look at the Academy, the link is in the bio, all right? So guys, trade safe, okay? I'll talk to you guys very soon.